Good evening, my friends. Tonight we have a special treat for you. I'm Tony Batista, he's Tom Sosnoff, and our special guest, Karen the Super Trader. Welcome.
Thank you. It's great to be here again. For the third time.
Hello, Bat. Hi, Karen. How are you?
I'm great.
How do you like the fact that your official name has been changed to Karen the Super Trader?
There's another person out there that's not me.
Really?
I just no. I can't get my arms around that.
Tony and I were talking before the show started tonight, and we tried to figure out who named you Karen the Super Trader, and I think it was Tony V, our producer. But I'm like, that was the greatest name choice.
You never would have picked it.
Thank you so much.
Nor would I.
Thank you so much for coming back.
It's a pleasure. Thank you for asking.
It's been a year and 3 months since our last talk. I think it was like at the end of 2012 or something.
And what a year it's been.
And it was a challenging year. How was 2013? Not results-wise yet, but just like, were you challenged by the fact that volatility was so cheap all year?
It was murder. It was very challenging. It challenged us from all perspectives of how we traded in 2011, how we traded in 2012, and then 2013 was just a curveball.
Were you challenged in 2013 because the market went up pretty much the whole year?
And the VIX stayed down.
And the VIX stayed down.
We want volatility, and we didn't get any in 2013. So it was a real challenge.
What's your volatility wheelhouse? Like when you look at the VIX and you say, if I could set this thing at a certain number, like my perfect number would be?
Perfect number, I would pick 20.
20. 18
to 20. When it popped to 19, I was in heaven. I love it.
Last year, Tony and I, we traded every day, just like you traded every single day last year. So I think I think we feel pretty good, Bat, about having this conversation.
Absolutely. When you're talking about volatility popping up to 20, you're talking about 4 or 5 days ago, right?
Yeah. And I can't wait till it comes back. If we could have a whole year, 15 to 20, it would be terrific.
So let's talk first before we get started. And I promised everybody listening tonight, thanks to the entire Tasty Nation for coming out tonight. I promised everybody that last 2 interviews we did, they were designed to be really inspirational. Tonight, I wanted to be inspirational, but also get into some specifics, some of the mechanics, some of the processes you use. But I think we first need to at least have a little discussion about 2013, because we haven't talked to you since 2012. Now, I didn't ask you, and you didn't. We didn't really get into specifics until today.
Right.
Let's talk about 2013. Your primary product in 2013 was what?
SPX.
And I would say that you, based on what you said to me, either SPX or the equivalent SPX, futures options, that was almost 100%.
Yes, is SPX.
Almost 100% of what you traded. Okay, because that's really easy to relate the VIX to what Karen traded.
Sure.
No earnings plays, no special situations.
No.
Just the SPX and the S&P 500. Okay. I looked through very carefully. We discussed your results last year, and you are currently managing about $196 million.
Yes. Yes.
And let's talk a little
between
bit.
Between two funds.
But they do basically the same thing. $196 million, and one fund returned net after expenses 27.5%, and the other fund returned net after expenses 24%.
Yes. For 2013.
You should be ashamed of yourself.
I'm already ashamed of myself. That's why I'm here tonight, to show pity for myself.
But it was a tough 27.5%. Our benchmark's the S&P, and I so wanted to beat the S&P.
Like, why is the benchmark your S&P if you're actually trading? You know what I'm saying? I obviously you need a benchmark for discussion purposes. But if the S&P is down 30% 1 year, that
you don't want to be down 25% and do better than the S&P.
No. But just in 2013,
so you're saying if the
I got so close. So you're saying
if the S&P has a positive return, you want to have a positive return that's much better than that?
Yes. What we do, we should at least be able to beat the S&P. That I'm always going to have that attitude, but never lose money. And that's my attitude. Can we lose? Of course we can, but
Index
we
funds.
certainly don't start out.
Index funds, bullish index funds, long stock funds were about the only thing that came close to, matching the S&P, that kind of thing. Most of the stat ARB funds, the long short funds, the index ARB funds, most of anything that had bonds or mixed instruments in it, nothing even came close to those numbers. In fact, most of the hedge funds were less than 5 or 6% that weren't just long funds. How does the world deliver a 5% return on basically an ARB fund, and you can deliver a 27% return? And this is a real number. $200 million is a real number.
It's a real number. It's really true.
Oh, don't worry. We will. And the crazy part about it too was you didn't have a losing month in 2013.
No, and we were talking earlier. I said we close out every month with a real hard close. We don't take the luxury of rolling out to next month. So when we have a return like we had each month in 2013, those are real closed positions, no rolling out to the next month. So,
just to put some of these numbers in perspective, okay, at 24, the average return between the two funds, one was 27.5% and one was 24%. This is after all fees. Okay, after all fees. How'd you do in January this year?
We were up 2.2% for the month, and the S&P was down 3.6%.
There you go.
We had a good January, yes.
So you have a streak going from the beginning of last year, 13 straight months. You're definitely buying dinner tonight because this is ridiculously incredible.
I should be ashamed of myself. You got a new nickname coming for you.
Let's just say the
maybe
average.
After this, you should be saying that I should be buying dinner.
The total return after all expenses and everything was paid, and I don't want to get into a lot of your specifics about expenses, things like that, but let's just say it's incredibly fair fund. You still netted out over $50 million.
Yes.
Yeah, that's coming from a professional background because you trade products that we traded. It blows my mind.
And you know my background. I mean, I just started by going to a class and thinking, that sounds really interesting. Maybe I can do that.
No, I'm looking at you over there, Saznoff. You're never too old for some school.
Karen, what about how many people work for you?
We have 7 in total, and that includes me.
7 in total, and 6 of those 7 are traders?
One is a controller.
Okay. But the rest are traders?
Yes, the rest are traders.
And how obviously, you've got a lot of stuff going on, so there's a lot of other people participate in the process of executing trades. Mm-hmm. How do you ramp those other traders up? How do you get them up to speed?
It's the power of being in that room. We've got great people in that room, and the success goes to all of them. We are in a big, not quite a circle, but we turn our chairs around and we all talk as a group, and we plan and strategize as a group, and there's a lot of power in that. And if anyone that's out there trading by themselves, outside of watching you guys every day, find a partner, find somebody you can trade with. There's a lot of power in that. So we get a lot of ideas going back and forth all day. It's very energizing. I love it. You
told me earlier you made almost 50, as a group, all the funds, almost 50,000 trades last year. Mm-hmm. I'm not even going to get into how much that was in fees. But your average size trade is 500 contracts.
About 500 contracts would be the average size
in
trade.
The SPX. Mm-hmm. And we know, Tony, that that's the equivalent of a 5,000 lot in the spiders.
That's correct.
Yes.
Just in SPY.
That's the main reason I don't trade spiders, is because of the cost of trading that many, putting on that many contracts in the spiders. SPX.
Have you looked at liquidity anywhere else outside of the SPX?
No, we have never had a problem with liquidity in SPX, and we also trade the options on the futures, the ES minis. We look at the Russell, the RUT, and the NDX, and we can always go to that if we're looking for some other position to put on. But our basic index is the SPX. There's also a tax advantage to that too. We get a 1256 contract tax advantage, so our investors get a tax advantage on top of all that.
There's I I mentioned this to Tony earlier.
With Tom's performance this year, he doesn't have to worry about taxes so far. No, it's not going to be an issue.
Those lost carry forwards, man. I got enough of those.
He's got those buttoned up. We're fine.
Well, that's good. That's good tax planning. You know.
No, it's not.
No, it's not.
There is in the retail side of the business. I just want to be very clear because people get all, they think, oh, you bring in a pro, and you are a total pro, but you use the same technology that everybody else, not everybody else, but that any other do-it-yourself investor can use.
I started with covered calls. That's what I was taught. My background is in accounting. I'm a CPA. I've been in management and corporations. Fundamental analysis was my bread and butter, and I learned how to do covered calls, and I do the fundamental analysis, pick stocks, and sell covered calls on them. That was how I started.
But the technology you use today is the same technology that Tony and I use.
Mm-hmm. Yes. Yeah.
Does it feel strange? I mentioned this too, I think earlier. I think you're probably the largest do-it-yourself investor in the world. It's hard to fathom, doesn't it? I mean, as far as activity goes, which is really interesting to a lot of professionals and stuff that are listening to the show because to maintain, we all know how hard. I don't care how good. I've been doing this for 33 years, Tony, almost 30 years. We've never had a 12-month
run. No. Not like that. And not those kind of numbers that they did.
It's crazy. I want to get into a lot of kind of specifics with you. But first, before we start, so many people have emailed me over the course of the last year, and they constantly ask me one question. How do you deal with, how do you personally just deal with in your brain, how do you deal with the risk that you take? How do you, best put, how do you sleep at night?
When I got involved in this, it's partly because of my background as an accountant, and I referenced, I think, on one of the shows.
Total risk takers.
That's, yeah.
Absolutely.
We're on the edge.
Calculated
We're
risk
on the
takers.
edge. I can control the emotion of fear and greed. You take the fear out of it, you take the greed out of it is important too. And it's just statistics. My brain goes toward the statistics, goes toward the math. So I referenced that it was like playing a big game. And it is to me, but it's very structured. It's not, I'm not rolling the dice. I'm playing in positions where I've said many times if I could walk up to a blackjack table and know I was going to win 95% of the time, I'd be sitting at that table all night long. And what we do is very similar to that. If we're in a 2 standard deviation, we're at a 5% probability of in the money, 95% odds that our play is going to be successful. Those are great odds. So I have no problem sleeping at night. We're making intelligent decisions and managing those decisions very well.
Did you introduce into one of the cool things about options is that they're like a gray area, strategic instrument. Did you introduce new products into your strategic mix this year, or did you introduce new strategies that you hadn't done before?
We probably migrated over to the SPX and the ESs and just stayed in those so we could focus. 2013 again was a great challenge. We had a super year. It still was a challenge. 2011 with a high VIX, it was very easy to trade in 2011. So we concentrated in the SPX and the ESs. We focused on that, and we had to pull the edges in a little stronger. In 2011 and 2012, we were more out at the 2 standard deviations. 2013, it was probably closer to 1.5 standard deviations. It's easier on the put side to stay in that range, and on the call side, we really had to pull it in. We went to a shorter time frame on the call side. We look out about 2 weeks. The puts, we were still looking at monthlies, and we we had to pull those edges in, trade with more closer to the money than I'd like to, but the market demanded it.
Okay, so let's talk about this. Let's get into, let's make this the official start here and get into some real specifics, because people are like, they're man, I'm telling you, Karen, they're fascinated by you. So
appreciate that.
Let's get into some specifics. You just mentioned things like 1 standard deviation and 2 standard deviation. Let's talk about just kind of a very broad picture. And what we did is we actually are going to look at this on 2 different platforms. So we've kind of set it up so we can see. But first, we'll explain it. Just talk about your most basic strategy, because you just started to talk about a little bit. Just talk about the most basic strategy, kind of your go-to strategy.
I loved your show on theta. We live on theta and the VIX. Under normal circumstances, we would go out we use 56 days. And the reason we use 56 days is when we go out that far, we're putting trades on and letting theta start decaying those trades, and we take them off and pull that profit back into the current month. So we're putting on trades, pulling them off, putting on, pulling them off. When it gets down in the 40-day neighborhood, we'll leave them on in the next month.
Now, first of all, let me stop you for a second. When you say you're putting on trades out 56 days, based on what we know about your trading, you're putting on the put side.
Put side.
Put side only, and you look at both sides independent of each other.
Independent, completely independent. We're never putting on any spreads. Never. They're independent. What do we need to do on the put side? What do we need to do on the call side? And that was very important in 2013. 2013, with this market just roaring up, we had to stay lighter on the call side. Had to. But we were maxing out what we could play on the put side. Okay,
so far my understanding is that you'd go out 56 days on the put side, and you would put on trades that were the equivalent of a 2 standard deviation move.
About 5% on the 5% probability of in the money.
On the put side.
On the put side. And you would have the equivalent 2 puts to 1 call.
That's a good way to look at it.
And how about the call side?
The call side, we would go, we're looking more about a 2-week period out and using 10% probability in the money. Because the call side is more difficult. And when the volatility is low, it's more difficult. You can't make any money. If you were going out at a 5%, you'd be getting 10 cents for your trades. So we had to pull that back in and play it a little tighter, but shorter time period. So we're at risk for a shorter period of time.
So in 2013, just so everybody gets this, you'd sell 2 puts at 2 standard deviations out of the money and 1 call at 1 standard deviation, approximately 1 standard deviation, maybe a little less, out of the money. And the calls would have 14 days to go to expiration, and the puts would have 56 days to go to expiration.
Now, do we do that 100% of the time? No.
Of course.
I also look at the trend. Number one thing we learned in trading is the trend is your friend. Look at the trend first. In 2013, we were doing projections on the call side. So if we got some good premium 50 days out and we could project a trend out and we could get well above that position, we would do that.
You're not a technician, is that correct?
No, I'm not.
Do you use technical analysis at all?
Use Bollinger Bands, 2 standard deviations, the price, and that's about it. I look at the fibs.
Do you use fundamental analysis at all?
Not at all.
Do you use any...
One of the beauties about being in the indexes, I don't have to do any fundamental analysis.
Something that you told me once that I found fascinating, you don't look at delta.
No. I like the strategy of delta neutral trading, and I've gone to some classes about that, and it's got a lot of merit to it, but it's not, I don't use it for what we do. Don't need to.
Before we get into any adjusting or anything like that, I just want to, I want to, again, focus. You're out 56 days on these puts, and 1 week, 2 weeks, or 3 weeks later, you're already closing those trades and reestablishing the next 56-day cycle. And on the call side, you're out 14 days. And within a few days or a week, whatever it is, you're covering those calls and then reestablishing it, which is what kept you in the game during this crazy bull market in 2013.
You're looking for a generalization. That's a generalization. But I'm always looking, what's the market telling me right now, today? And sometimes we vary from that. But if you want like a basic strategy, that's our basic strategy.
And you would not do those as a single order. Like you would not be doing ratio strangles. You'd be doing the put side and then the call side, both independent of each other, almost like you're two separate traders.
But on the puts when the market's going down, the calls when the market's going up. Even in a market like 2013.
Well, hold on a second. You just said something pretty important there.
So you're selling into strength.
And you're selling into weakness
That's
when,
exactly
the
right.
market's going
Both
down.
times it's selling into strength.
Right. You're selling puts.
Right. If it ends up, we may end up with 1,000 positions on the put side and 500 on the call side. I see them completely independently of each other. I never look at, I've got this much on the put side, so I need to balance it out and put this much on the call side. That thought never crosses my mind.
The takeaway.
So you've got to be active all day long, though. I mean,
all day long.
Okay. So it's not like, I don't want to set the expectation of everybody that's listening out there that you just put this on 2 weeks out on the call side one time and 60 days out on the puts 2 times, and you're just setting it, forgetting it, going on vacation and coming back.
Oh, I wish.
The takeaway for most of our viewers is that you're aggressively managing your winners, which is something we learned in 2013, how valuable that was. And the other takeaway is that you're selling into strength, meaning you're selling calls into rallies and you're selling puts into sell-offs, which is what we call selling into strength. And you are creating a ridiculous number of occurrences, but given the size of your portfolio, that makes sense.
Yeah, we work under portfolio margining, which helps us. We have a large amount of money. And that's funny to me because when I started this, I never would have dreamed this would have happened. Never in a million years. Just started managing a small amount of money, and it just.
You're the super trader. Tony,
that's why you got the name and he doesn't.
Tony he's here. He just wants to hear me say naked put.
That's right, naked.
We brought up a couple of different pictures of based on what you told us. First, we're going to bring up the TOS platform for a second. And this is the analysis page. And a lot of people have asked, how do you set this page up? In fact, it was an email that we've got. We got an extraordinary number of emails over the last year on how you set that up. So what we did is we took one call that was just about 1 standard deviation out of the money and 2 puts, and we set the screen up. I know it's going to be hard for you to read it from all the way over here, but
that's the February 1850 call, which is 1 standard deviation away, and you're doing that one time, and this is all in the SPX, and then you're going to the April options, which is approximately 60 some odd days out, and you're going to the 1630 puts, which would be 2 standard deviations out, and you're collecting approximately $6.25.
So
I just rounded the numbers.
You add those two together, Tony, it's $6.25 twice, and then $2 once. That will explain to a lot of people why you made money in 2013, because that is a very long delta. It's a bullish position. Now, what did you do, Karen, to those price slices, and how did you set that up?
I don't know that there is any magic to it. We just use 7 slices. We have on the TOS platform, we are graded by 10% up and 12% down. So those numbers can never exceed our net lick. What we do in 2013, because of what the market was doing in the low VIX, we take the current price, we subtract 100 and take 88% of that. And then we plug that number into that pie slice down at the bottom, and we pretend, that's the best way I can describe it, as if the market has already dropped. Because markets don't crash up except in 2013. They crash down. So our risk level is truly to the downside. So we manage it as if it has already dropped that much, and we're watching that that lower number against our net lick.
So you're basically, where I put the circle there, that 1512 and change, you're basically saying that, hey, what if the market goes to that point, that P&L, that $24 million, if you're using the type of numbers that you're throwing around, that's what you're looking at as your risk.
Right. The real number is the $12 million.
Correct.
At the 12% down.
At what toss would
we
look at.
manage it off of the $24 million. That number.
That's your cushion.
That's my cushion.
Your safety.
Your risk management is there.
The risk management is there. In 2011, we were working 200 points off the current price in 88 because of the volatility.
Sure. I
love volatility. So right now with the low, when the volatility was running 11, 12 in 2013, we had to pull that up to 100 points down.
So just to explain it one more time, you take the current price, you subtract 100, and you take 88% of that.
That's the
number.
12% drop off of that number.
Which, Tony, if I can read correctly up
it's
here,
1512.72 is the number that you're looking for. The current price is 1819.
That's right. And then you measure that against your you measure that risk at that level against your net lick.
Against the net lick. Mm-hmm.
Very
when the
unique,
volatility comes back up, we'll go back to the 200 down and the 88% of that.
We also have another platform that we just built called Doe, and if you can see it, it's very visual on there. We don't have it set up, but you can see there the same position, the short weekly, the short call, and then the out of the money put, and you can see the bell curve. It's actually log normal, but whatever. And then you can see the
you're looking at the 2 standard deviation is right here, and
right.
I'm just looking at the April options, and then you're 1 standard deviation away on the 1850 call, which 1850 calls would be around 1 standard deviation on the options with about 9 to 11 days.
Looks like the total credit on here is about 1450. It'd be the same, obviously, on both.
Smaller period of time to manage the call, longer period of time to manage the put.
It's remarkably simple, and obviously it's been working unbelievable. Do you ever get nervous about? We trade very similar, except that I like everything you do, except I can't do it without being net short deltas. And I figured out the whole reason why you make so much money is you didn't carry all those net short deltas in 2013.
That's true.
Do you worry, though, about because a lot of professionals will, if they're going to be short premium, they're going to be short delta. You don't have that on. That negative drag didn't hurt you last year.
No. No, I don't worry about this. The question comes up to me a lot, and sometimes I think maybe I'm not worrying about something I should worry about. But this is a tried and true for me. I've been doing this since 2008. I truly live under the if it ain't broke, don't fix it. And we managed this well in 2013, obviously because of our returns. I'm always interested in tweaking it, learning something new. We have one person in our group that particularly likes to come up with new ideas, and we always talk it through and work at it. And if I can find something that makes this a little bit better, I'm going to embrace it.
2013 was a year where there was no sell-offs in the market, yet you maintained this 2 puts to 1 call all year long. And you even maintained it, I assume, into January of this year and didn't get hurt on that little sell-off.
No, we were you couldn't hear us shouting when that VIX went up. We loved it. That was me. That was me.
Do you run away when the VIX is 12 or 13? I mean, do you stop trading? I mean, a lot of times we get questions from people saying, I can understand if you're selling volatility when VIX is high and you're ramping up a little bit and you love it. Do you stop when it's 12 or 13 or 11?
No, we were very busy in 2013. And with the point about the theta, when we go out like that, we're looking for opportunities where it moves. We can get a 20, 30, 40. We love it when it's 50%. We close those positions down. So we're not just going out at the 5% level, the 2 standard deviation, and just sitting there and doing nothing. We're actively pulling that profit back, taking that off the table, taking that risk off the table. So there's just a constant flow going on with the positions. And at some point in time, we just say, okay, everything we've got on, like in March, we're just going to leave in there, and we will go into March with a healthy profit already built up in March, and we'll stop that pullback. We'll go into April and start putting positions on in April and pulling those back and taking the profits off of them.
It's very few traders, very few managers think that way because it seems like an extra step.
Who cares? We're making money.
I don't. You're right. You're right. I just, at what the next big subject is. Okay, so you have this position on. You're short 2 puts. You're short 1 call. You have your perfect position on, and now all of a sudden, obviously, we can see how well it works to the upside because there's almost, the markets don't crash up. They can go up, but they don't crash up.
In 2013, I think it crashed up.
Okay, but it worked because you had basically
the volatility contracted.
Yeah, volatility contracts. That really works for you.
Your short-term options. I don't mean to interrupt you, Thomas. Your short-term options that have, let's say, a week to go, and the market's been rallying up for the last 5 or 7 days, and you can certainly see the market going up 5 or 7 days in a row. You then take those options off and move them to the following week and leave your puts in March?
We move them if we have to. I always want as many positions to close out in the current week as I can. We make more money by not over trading. When we're in the current period, I want to see those things expire. I want them to go away. And then that frees up, on our Analyze tab, frees up plenty of room for us to go out the next 14 days and be putting positions on, and we just make more money doing it that way.
So the market starts to reverse a little bit and it starts to go down, and all of a sudden your 5 delta puts, both of them, 2 of them, go to 10 deltas. Do you make an adjustment?
No.
Your 5 delta puts go to 15 deltas. Do you make an adjustment?
No. Keep going.
Your 5 delta puts go to 20 deltas. Do you make an adjustment?
No.
So where do you make an adjustment?
I'm
30.
At 30. So your 5 delta.
I'm not going to ask anymore how does Daddy do it. I'm going to ask how does Karen do it.
Your 5 delta puts have now gone to 30 deltas. Now they've got teeth. So what's the Karen move?
When that happens, and that's just that's, I could say that's an arbitrary number, but I do not want a position going in the money. When you get a position in the money, then you got a lot of other trouble.
Got headaches. Yeah.
That's what keeps me up at night, is something going in the money. So in a normal course of the day, if it gets up to 30 delta, there are a couple of questions. These are not hard and fast rules. If it's Friday and they're going to expire in 2 hours, I leave them alone.
No, forget about that. But let's talk about 30 delta with a month and a half left to go.
I move the position. It wouldn't be a month and a half. It'd be in the current month.
Okay, in the current month.
I'm going to move the position. We keep enough capital available. That's why we don't on the Analyze tab.
What does that mean, move the position?
We're going to, if it's a put, we take the put off. Then we will either place another put further away from the money, get back down to maybe a 20 probability delta.
Yeah.
And maybe we lose $1 or $2 on that trade, putting it in a safer position. We will
because
usually
you go
make
out
that
another month or so?
No, we never go out in another month. We might go out another week.
Okay.
We either are going to try to fix it in the current week because, again, I want those things to expire. I want to get the contracts off. Or we push it out another week, and that's where the weeklies have come in so handy for us. We push it out another week, put it in a safer position, and we will make up that money somehow, either increase the number of contracts cautiously or put some contracts on it.
Sell more puts?
Sell more puts.
Okay.
Or let's say it's 500 contracts.
Right.
We may drop it 10 points into the next week, sell some more puts down another 15 points, and make up the difference on the call side. It's a mathematical game we play.
Assuming that you play the markets are symmetrical game that we play, would you also roll the call side? Would you push the call side down? We call it the untested side. Do you take the untested side and push it down?
No.
No. So what are you going to do with the calls then? Because now the calls are cheap. They're 1 delta. Now what do you do?
they're either going to expire or we'll put new call plays out another 2 weeks.
So you don't look at the call.
We manage them. We manage the sides independently.
Mm-hmm. So you don't look at that call as an adjustment to that put.
No.
Wow.
No.
That's something we
maybe
definitely
I should.
don't do that.
Maybe I'll go back and start looking at that.
Well, I don't
know. No. Please, don't change it.
I don't want to be responsible.
Well, Tom told me to do this. So.
Okay, so it's all very fascinating because we would definitely. You will never run into a situation which we get into, which is actually having our position sometimes inverted. Like
that's a no-no.
Why is it a no-no?
Oh, we talk about one of our traders is always saying we want to be this, we don't want to be this. So
we don't want to be that, but we get that way. It's not intentional.
No, we just don't let that happen to get inverted. Because, my goodness, just think of what it would happen if.
How do you stay disciplined enough not to want higher implied volatility? Like, in other words, when there are different situations, special situations with lots of liquidity, Apple may be an example, Google may be an example, other stocks with lots of liquidity that afford you extremely high IV percentile, IV rank, just high implied volatility as a way to escape from the S&P 500 low volatility at some points, just because it's exciting. How do you stay away from that?
I often say in the hare and tortoise race, I'm the tortoise. We're the tortoise. It's I don't want to be guessing. I don't want to pick Apple and watch it. I owned Apple the day Steve Jobs announced he had cancer. I learned a lot about trading that day, and I've gradually wanted to move away from that. I don't want to be out trying to pick the next big winner or hit Google just at the time that it peaks out and turns over. It's just, to me, that's risky.
You mentioned in your last interview with us that trading was a game. Mm-hmm. And you and I know you've kind of gamified it in your own way, but what are the components? Because this is a great question. What are the components of that game? Like who are you playing against?
Oh, myself. It's two components. It's money management and risk management. And I think part of our success is just simplifying it, not getting rid of a lot of the graphs. Oh my gosh, when I first started, I'd have a screen with 12 graphs up, and I was following this and that, and momentum, and it was just, I made it as complex as I could make it. The simpler we made it, the more profitable we became.
We've listened to you talk about managing trades. We've listened to you talk about kind of now number of occurrences. Mm-hmm. And we've listened to you talk about implied volatility. These are things that are kind of the core, the foundation of what we talk about every day. And we've also listened to you talk about some of the things that aren't important to you. Are there other considerations like what the market's doing? Like, do you sit here tonight and go, like I sit here tonight and go to Tony, I can't believe the market's at 1819 the S&Ps.
And you guys took me down back.
And you took me down. Like
do you ever blame anybody else?
I don't.
It's a 6-member team. Do you ever blame them?
Do you ever blame me or Tony?
Well, we do have one person on the team that's responsible for either making the market go up or making the market go away. I said, now, I'm leaving for lunch. You are responsible. I wish the market would come down, but I have to play what's in front of me. I just have to play what's in front of me. And it's such a contrarian. I feel almost un-American when I say, gee, I hope the market drops today. Because I know everybody else wants it to go up, but I don't. I want the volatility to go up. It's more fun to have volatility. We can work our strategy so much better.
It doesn't matter what direction the market's going.
Doesn't matter. As long as the volatility's up.
That's what I'm saying,
if it's going up, volatility is going to be down. And
do you find yourself? Do you tell your team that there's a direct correlation between the number of trades you make, your level of activity, and your fund's results?
We don't talk about that per se, but the level of activity ties into our Analyze tab. We We just literally make our decisions based on that Analyze tab. So as we're pulling positions off, it's easing up on the Analyze tab. We're putting more positions on. And yes, that level of activity makes a difference in our results. Do
you recognize the level of your success? Because this is something that you're from a school, a background that's very similar to most of the do-it-yourself investors. Mm-hmm. Yet you've achieved a level of, if we're going to measure by just dollars made, numbers that 99% of most professionals never get to at any level. Does that? What does that do? Like,
I don't think about it. And in my mind, we won't go into the depth of this, but it's not the what I do, it's the why I do it. And that's my motivation. What a privilege it is to be a part of this, to just have this as a part of my life. I'm grateful every morning when I wake up that I get to do this.
You love coming to work every day.
I love it.
What's the first thing you do in the morning?
First thing I do in the morning?
Yeah.
I check what you've said on your email, and I look at CNBC and see where the market is, and see what the overnight market, what the Europe and Asia markets did.
Does your firm, do you research, do you do a lot of, is your stuff real, is your business real time, or is there a lot of research that goes into kind of studying the way you generate your results? In other words, do you commit a lot of resources and capital to researching kind of your program, or are you doing it all kind of real time on the fly?
We did at first. I spent hours and hours and evenings and Saturdays and Sundays, and we've brought it to now we're doing it on the fly. It's the energy in that room. We have exceptional traders. They know what to do. We disagree with each other from time to time, and to me that's when it's at the best, because you get new ideas. It can get a little stale every once in a while, and I love it when somebody just one of the guys will challenge us, and we have to think about some things a different way. And we test. We may pick up something that you say. We may get some idea, and we'll test it with just a small number of contracts, and that's been fun. We've done some risk reversal positions, and one we run one really big on, and one we made a little on. But but again, that's just a little tiny tweaking.
Do you ever tweak with direction? Take a little risk directionally?
Rarely.
Wow.
I just don't want to go down that road, because my crystal ball cracked and it's in the shop and they haven't fixed it yet, and I don't want to be doing that. Now in 2013, just the methodology that we're using, the 2-to-1 ratio and all that came from the direction.
If I am a struggling young trader like a Tony Battista, if I'm somebody that's been
I feel like the third wheel on a date over here. I'm not gonna lie, this is a new position for me. You're probably more comfortable with this position.
Let's say I've been trading for a couple of years, and let's say I've done the time, and I've read the books, I've watched the videos, I've traded, I've paper traded, I've traded lots and lots of 1 lots and 5 lots and 10 lots, and I've really committed, maybe not the quote 10,000 hours, but I've committed 3,000, 4,000, whatever it took. I understand how hard this is, and I'm not getting over the hump. What do you tell that person?
I really, that question really doesn't come up to me. First of all, how much money do you have to trade? It's a whole different world if you're trading $5,000 than if you're trading $300,000.
Right. Well, most people understand the linear part of that. Right.
A whole different world.
Right.
Portfolio margining helps me. I would keep looking for what you do best, because this works for me doesn't mean it's going to be your cup of tea. It doesn't mean it'll work for you. You have to find what is right for you. I don't trade bonds, and I know people who make money off trading bonds. I don't trade Forex. And there are people who make money off Forex. There are people who make money off calendars at certain times of the year. I found what works for me, and I would just encourage people to find what works for you. Don't try to duplicate what I'm doing. Find what works for you. What is your risk level? What's your money management?
But assuming your risk, assuming that everybody's, you define undefined risk as 2 standard deviations.
Mm-hmm.
That's what makes you sleep at night. 2 standard deviations. Mm-hmm. So assume that, okay, I love that thought process because I have the same thing. I assume undefined risk is 2 standard deviations. But how do you tell somebody that's, again, trying to get, they understand that they're very limited sometimes by capital. Mm-hmm. But how did you get from, you were limited by capital too.
Right.
How did you get from being limited by capital to that next step?
When I started, when I got past the covered call stage, I was trading iron condors.
Okay.
Just went down that, and I'd leg into them. And I was using a 15 delta. So when the market would go down, I'd put on the put side, and the market go up, I'd put on the call side. I was looking at the profit I was making, and back then I was still selecting stocks. Mm-hmm. As I kept studying that, I thought, I can take off the long side. And again, stepping back and looking at the big picture, there are times that I would just roll the long side of that forward and let the short side expire. I stopped seeing things as all tied together. Each play, if you put on a strangle, a straddle, an iron card, you can look at each piece of that as an individual piece. And I started looking at, I could make the same money off of that buy-sell trade, go to the 5% out of the money on the put side, and make that same spread that I was making. So that's when we went naked.
I love it.
I get all that, but you would never do anything in the markets where you didn't have what you thought was a probability type of edge. Like, you're not going to do something. You're not going to go out and buy a 20 delta call, are you?
No.
Right.
No.
Never.
No, never. No, never. What I like about the short, the selling premium, if you are buying calls, buying puts, you can only win if the market goes one way. And it has to go that direction significantly to overcome the theta decay. I can sell premium and make money if the market goes up, goes down, goes sideways. Why wouldn't I choose to trade that way? One way I can only, in the long premiums, I can only make money one way. The selling premium, I can make money 3 ways. It made sense to me. Why wouldn't I just go to selling premium and forget about buying calls, buying puts?
One of the questions that comes to Tony and myself all the time about you, and I agree with that, by the way, because that's the same exact way we trade. It's exactly the same way we trade. But one of the questions that comes to us all the time is, it has to do with how you manage risk. Now, we talked a little bit about, okay, what happens when the 5 delta option goes to 10 deltas. Mm-hmm. But now the next question that comes to us all the time is, what happens when your position starts to just lose money? So one day your net lick is $100, and the next day your net lick is $80. So the options didn't explode, but you just lost, $20. What do you do?
And it's very frequent that in those unrealized positions we're losing money. That if the market's moving in any direction, but the positions themselves, in my mind, are perfectly safe. So we're managing off the analyze tab. Worst case, I'd buy some low-valued puts. I would buy some calls, just offset that push that we're getting from the market move. We don't have to do that very often.
I was going to say,
if the position's losing money, I don't care as long as the position itself is still safe.
So you really don't over-manage your positions at all?
Try not to. Only when they need our attention.
You stick to the discipline. If you don't get through that level, you're not going to make an adjustment.
No.
And you're never going to move down the other side to adjust that position either.
No, because what if the market turned on me and now I've taken a perfectly safe position and put more risk to it? I would rather a position expire and free up that space so I can go out and sell some more.
Do you ever look at it as a percentage of gain on just take the $100 that Tom just threw out there? Do you say, like, if I get to a 50% gain or a 25% gain or a 90% gain, do I look to take it off?
We do when it's in the next month.
So you're talking about your two puts in March.
Month.
Got it. So the front month you're pretty much actively trading, and that back month you look at it as that's my annuity that's going to be coming in the next 60 some months.
That's a good word. Yeah. Yes.
See why I'm here.
Yeah. That's.
Do you think? Okay, so since we've traded for so long and we understand kind of some of the, we understand how hard it is to make a lot of money. Mm-hmm. To make a little bit of money, when you stay small, I think it's reasonable to assume you can pull it off. To make a lot of money, man, it's hard. 50 million, 70 million, 90 million, whatever you've made over just the last year, those are, again, I'm going to get back to this because it fascinates me. Those are crazy like numbers without the, I know you've maintained a little bit of long delta. Is the, can you do this into perpetuity? Meaning that, like, are you confident you wake up next month? Obviously you are, but I mean, what drives you? Is it the game part of it? Is it the game itself? Is it the love of the game? Is it just that you think that there's this mathematical, you can see that mathematical equation? What did we call it the other day when you, big fat pitches?
Big fat pitches.
Big fat pitches. So everything looks like does everything look like a watermelon to you coming across the plate?
Well, I have to think about that. It's the confidence. I have a high level of confidence in what we do because it's proven, and we've done it over and over and over and over and over. It's like, go to the start batting practice and hit the ball. You're going to be better if you hit it 500 times than if you hit it 10 times. And I've just got a high level of confidence, and you know the why. So what motivates me to do this every day? It's a means to the end. It's the why. It's the charity. But what we do with the charity.
Right, and we're going to get to that, and we're going to get into your whole charitable thing in just about 2 minutes, 3 minutes, because I can't wait to talk about that too. Because I mean the complexity of, maybe it's the simplicity. Maybe I'm thinking it's all complex, and maybe it's just the simplicity of it. Because maybe we make more out of it. What I love about
it's keep it simple, Sosnoff.
Yeah. What I love about
he's always overcoming. You love that. See, let me talk to Karen for a little while over here.
I like that.
I tried to cover how you adjust your risk. Tried to cover how you manage your winners. And when I say adjust your risk, you're really all just about managing your winners. That's pretty much your whole business.
And
put on lots of
staying
trades.
out of trouble.
By managing your winners. You put on trades with 56 days to go, and you're taking them off by the time they have 40 days to go. And then you're just constantly you're in that part of the decay curve that is steepest.
Yeah, I love that. I love that curve. Yeah.
How the hell did you figure this out? Nobody else did.
I don't know. I just studied it and studied it and studied it, and it just made logical sense to me. I'm an accountant. For goodness gracious. It made sense to me. The numbers made sense to me.
So let's take it a step further. You keep talking about this mission.
Watch me light up.
I am watching you light up. You talk about this mission, and you love coming to work because you give away most of the money that you make. Tell me about it.
Well, the public fund that we've been talking to, 27.5%. It's outside of paying expenses. It's all. I've gifted my ownership of that company to our foundation, which right now we're working in Africa. So
last time you were on the show, you talked about building, water purification systems, and now I heard you're really getting into you built a plantation.
Pineapple plantation.
A pineapple plantation. Yes. What do you know about pineapples?
I know nothing. Isn't that fun? That's the exciting part. I know nothing about pineapples. So I'm over in Africa in November on the ground digging with my hands, planting pineapple suckers. I was thrilled.
We brought one of your business partners with us because we want to talk just a little bit about it. We didn't want to put you on the spot telling how great you are. Tony can talk about how great he is.
Yes, it's
or how great I am, but we don't want you to talk about how great you are.
Usually Tom says something to me like, hey, Bat, tell him how great I am. And then I have to go on. It's a contractual thing.
But you've got notes over
That's correct. I do.
Without getting into the background, I just want people to understand what you do. It's just it's off the charts. I think we called this kind of impact investing. Jay, are you there?
Here.
Sure.
Yep.
Hey, Jay, how are you?
Doing great.
Oh, good. We can see on the screen right here. So you're a business partner of Karen's, and you're managing director, and you work with her, and you've been to Africa with her. What's going on? What are you guys doing?
It's incredible. It's we all talk about Karen as a super trader, and I've been taking copious notes over the last hours listening to you guys, but she really is. She's a super person, and I think that's something that, frankly, your listeners should learn more about. Karen is, I would characterize her as really an ambassador for conscious capitalism. She's gone out and taken the best practices of trading and capitalism. And sure, she does a super job with returning, getting a good return for her investors. But a portion of that she's allocating to essentially spreading the best practices of capitalism around the world. So she realizes that it's better to go out and give a portion of the population a hand up instead of a hand out, and it truly is. It's remarkable how it's working, and it's remarkable to see that her commitment is paying off around the world.
You mentioned earlier you called it performance with a purpose.
Right.
I love that term.
Oh, it's great.
It's conscious capitalism. Tony, conscious capitalism, by the way, is not you driving a gypsy cab in Brooklyn, by the way.
I was just looking it up. Are you kidding me?
You probably didn't know that, Jay. But you went over to Africa. You guys built it with the proceeds from the funds, which is just, this is where you differ from most traders, okay? The proceeds from the funds go into a Lamborghini. The proceeds from the funds went to a pineapple foundation, a pineapple plantation and everything else. Talk about it, Jay. Just what was it like?
Incredible. So you went through the math briefly, but if the firm returns, say, $10 million, $8 million gets returned to the investors, and we're all very happy about that. But about $1 million of it goes to cover some of our overhead, and about $1 million goes into a foundation, which Karen manages. And she finds places like Sierra Leone that are on the very bottom of the Human Development Index. And she goes over and she gets on the ground. She's boots on the ground, gets engaged with the people there, finds out what they need, and figures out the best way to essentially provide opportunities. So it's a protracted effort. It's not something where we go in and just either try to give people a solution for a day or a meal for a day or for a week, but really give people the opportunity to pull themselves up and be successful over time.
Did you actually plant a pineapple?
I did.
I witnessed it, yeah. She got her hands dirty.
And he did too.
He did too.
We were all on our knees planting pineapples. We've got 100,000 pineapples planted.
100,000.
You call yourself a human being. You should be ashamed of yourself.
I am ashamed of myself.
I'm ashamed for you.
Jay, it must be amazing at this point. I know you trade as well, and because I've met you in the past, and it's it just must be kind of a fascinating transition for you just to witness this whole thing. It must be cool as it can be.
It's incredible. It really is. It's such a rewarding experience to be able to go to work and sure maximize shareholder value, but also have a larger purpose. The performance. Our purpose with the performance is a wonderful thing that gets you out of the bed in the morning. By the way, Karen likes to have Diet Coke to get out of the bed in the morning, too. That's another thing.
It's okay. My friend over there likes a croissant. It's okay.
Jay, thank you so much.
Thank you.
Thanks. That was great.
Jay.
That was really good, and I'm glad that he came up here and just to talk about it, because I know you won't talk about yourself, but that the whole idea of not as the conscious capitalism I get, but the impact investing. We have an impact engine incubator here in Chicago, and I mentioned that to you. It's just kind of incredible. We are focusing right now on a new demographic. Ages, the millennials and everything else, ages 21 to 35. We're building technology for them. We're building a network for that demographic. We're building software for that demographic. How much different is the world in financial literacy and investing going to be if we're able to imagine if you were 21 and all of a sudden you had all these crazy tools? Would you have had gone for the same degree? I don't know. I'm just curious. What are you thinking?
That's I try not to even think about if I knew then what I know now. Especially for women, getting more women. I'm on the board of directors of an organization their focus is to get girls in school interested in finance as careers. So I'm seeing that organization is doing a phenomenal job. You know more than you have a daughter involved in this. You know more about what the next generation's learning and the tools that are accessible to them. And I'm watching it. I got started so late in life.
Yeah, but I'm watching it, kind of that whole generation explode. What if we could say something as we leave our viewers, or as we wait to the next session? If you could give just a couple of kind of bullet points, just a couple of heads up. Hey, here's something to look for in 2014. Here's something I'm doing, like just a couple of focus points. Something somebody could. I love takeaways.
Wow. Well, in 2014, for me, I just want the volatility to go up. I would encourage people to, I'd say, look at the big picture. I love what you're doing. If you've got to trade by yourself, then they should be involved with your program and do it as a group. Get some other input into what you're doing.
If volatility does expand, which is likely in 2014 after 2013 was so low, what would you challenge people to test strategically? Like if you're just kind of on the fence, and you're just getting involved for the first time, how would you challenge them strategically? Like what would you say to somebody like, hey, you know what, do this one lot, try this out, or like what would you say?
I am a proponent of the non-directional trading. I would just say stop trying to think you know which way the market's going to go. I've been bruised by doing that too many times. Go to a non-directional and try. You got paper trading. Find out what works for you. If I had a small amount of money, I'm still a proponent of the iron condor and trading on both sides and legging into it.
You are the super trader because you figured out on your own how to define undefined risk when the companies that were teaching you and everybody else couldn't explain undefined risk. You figured out how to define undefined risk.
I figured out what to do that I'm comfortable with it. And the Analyze tab to me is a very powerful tool. And we use, all of our traders in our room are just living by that Analyze tab. So we know exactly the idea of also pretending like the market's already dropped, and then we're managing that 12% down from that drop. When people say, well, it's just too risky, I don't see that as risk. I see that as managing. Our job is to manage our trading, and that's the way we manage it. And to me, that's managing our risk, not being not having an unhealthy risk level. We're intelligently managing it. So I'm comfortable with it.
Listen, I think it's been a great interview, and I think on behalf of everybody who's out there listening, you've been inspirational, and I'm in awe of you, so thank you so much. I do have one bone to pick with you. And please don't make that face, but you said one thing that's going to probably stick with me for the rest of my life, and I'll have to play penance for it forever. You said that the first thing you do when you wake up in the morning is you read Tom's Cherry Bomb email.
I do.
Now, he is going to say to me for the rest of my life, Bat, did you hear what she said? She reads my email first. When she wakes up.
The first thing I read. I've had to work at understanding what a quacking duck meant, but I'm getting there. Have
you got the barking ducks down?
I have half of it down.
Thanks so much, Karen. That was great.
Thank you. Pleasure to be here.
Thank you so much, Karen, for your time. Really appreciate everybody out there listening to us. Thank you so much on behalf of Tasty Trade. Have a great night.